Hello, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 5. Chapter 5 is actually on bond valuations, and interest rates. Bonds, bond valuation, and interest rate. In this chapter, we'll talk about the key features of bonds. We'll talk about bond valuation. We'll see how we measure yield, and we'll talk a little bit about risk. So determinants of intrinsic value. Intrinsic value of a company is basically the present value of all free cash flows. Free cash flow is the amount of money that is available for investors, amount of money available for investors. So after net operating profit, after taxes, we subtract required investment in operating capital. What we have left is the free cash flow. And in calculating the present value of free cash flows, we use weighted average cost of capital. That is a combination of cost of debt and cost of equity. So what are some of the key features of a bond? Some of the terms that we need to know as far as a bond is concerned. Number one, we have what we call the par value. The par value is basically the face value, or the amount that is paid at maturity is usually assumed to be $1,000. So it's the face value. A bond is basically a piece of paper that companies can issue, or even federal government, the government, or other governmental organization can issue to raise money. So when they make that piece of paper, they attach on it a face value. And for most cases, the face value is thousands. The face value, or the par value, which is the amount that will be paid at maturity. So the bond must not sell for the par value. It can sell for more than par. In that case, it is a premium bond, or it can sell for less than par. In that case, it is a discount bond. But at maturity, it is the face value, the par value, that will be paid to investors to terminate the bond contract. So we have par value. We also have what we call the coupon interest rate. The coupon interest rate is the stated interest rate. The stated interest rate. We can know the dollar amount of interest by multiplying the par value. We multiply the coupon interest rate to the par value, So if the par value is 1,000 and the coupon interest rate is 10%, for example, we take 10% of 1,000, that is going to give us the interest rate of the bond, which is generally fixed. Another key feature that we hear of when we talk about bond is maturity, which is the years until the bond must be repaid. So it usually declines. If it's a 30-year bond, the maturity is 30 years. So we gradually decline until we get to year 0. So that is maturity. Then we have the issue date. It is the date when the bond was issued. Every bond will have an issue date, the date when the bond was issued. We also have what we call default risk. Default risk is the risk that issuer will not make interest or principal payments. The possibility that the issuer will not fulfill their obligation. All right. Let's talk a little bit about core provisions. Some bonds have attached to it what we call core provision. So here the issuer can refund if rates decline. So it's basically a provision that is attached to a bond that makes it possible for the issuer to refund the principal if rate declines. So this helps the issuer, but it hurts the investor. It hurts the investor. So call provision, we can see it as a way that companies can refinance their debt at a lower interest rate, So companies are making payment, that those coupon payments are generally fixed. If interest rate drops and they keep making that payment, then they can be paying something that is higher than what the market is offering. So they can decide to exercise their call provision by paying off the principal and then getting a cheaper rate, a lower rate in the market. So it makes refinancing possible. So why it is a great thing for the issuer, it hurts the investor that could have been making a stable source of income at a higher interest rate. So borrowers are willing to pay more for bonds that have a call provision, and at the same time, lenders are placing a demand for more. So they want to be compensated on callable bonds. We have what we call sinking fund, which is a provision to pay off a loan over its life rather than at maturity, at maturity. So a fund is created where excesses can be deposited, and that can be used to take care of the loan principal, making payment to be possible over a shorter period of time. So it is similar to amortization on a term loan. It reduces the risk to investors and shortens the average maturity. But not good for investors if rate declines after issuance. Okay. So we want to go into the computation of bond value, how we compute bond value. And it's a straightforward formula that comes from our knowledge of time value of money. So the example we want to work on is assume that we want to calculate the value of a 10-year bond that has a 10% coupon if interest rate is 10%. If interest rate is 10%. So in this question, we are interested in calculating the value of the bond. This bond has 10 years maturity, coupon rate is 10%, and interest rate or yield to maturity is 10%. So if we put this on the timeline, we can see from year 0, somewhere here. So 0, year 1, year 2, and so on and so forth up to year 10. So it is a 10% coupon, which means that 10% of 1,000. So the par value is assumed to be 1,000. So 10% of 1,000, which is $100. So it means that if you were to buy this bond at the end of year 1, you will receive a coupon of $100. At the end of year 2, you receive a coupon payment of $100. Year 3, year 4, year 5, up to year 10. Year 10, you are going to receive the last coupon of $100, and you will receive the par value. That's why we define the par value as the amount that will be received at the end of the life of the bond. So this is how bonds work. You get periodic coupon payment, and at the end of the life of that bond, you have the last coupon payment and you are given the par. So in this question, we are interested in calculating the value of the bond. So we bring it at time zero because it is the value or the price, the worth of this bond. If this bond is going to generate $100 period after period for 10 years and the par, what is the value or the price of the bond? So the value of anything is the present value of all future cash flows. The present value of all future cash flows. So all future cash flows, we calculate their present value. So if we're to do this manually in a way that is very tedious, we'll calculate the present value of all this coupon payment for year 1, year 2, year 3, year 4, year 5, year 6, year 10, and then the par, the present value of the par. And once we calculate the present value, this interest is given as 10%, interest 10%, interest 10%. We add all of them, we are going to get a value of 1,000. The way we do this using the formula is that we understand that these are cash flows that is the same amount period after period for a finite period of time. So these cash flows, there are two types of cash flows we see. The first is an annuity, because the cash flow is coming period after period for a finite period of time and is the same amount. And then the second cash flow is that par value that comes at the end of the period. So that is a lump sum. So with our knowledge of time value of money, we are going to value this bond. The value of the bond is going to be the present value of an annuity plus the present value of the lump sum. So the lump sum or the maturity value. The maturity value. So we can do this with using the formula, or we can use the financial calculator in computing this problem. So bond value is equivalent to present value of an annuity, present value of an annuity plus the present value of a lump sum, or what we call the maturity value. So if we go to our knowledge of time value of money, present value of an annuity is payment 1 divided by I for interest rate minus 1 divided by I for interest rate, 1 plus I for interest rate raised to the power n. That is it, plus the present value of that lump sum. Present value is this future value, 1 plus I raised to the power n. So if we fit this in, the payment is 100. The interest rate is 10%, which is 0.1 minus 1 on 0.1, 1 plus interest rate 0.1 raised to the power n, which is 10 years, plus that coupon, that par value at the end is 1,000 divided by 1 plus the interest rate, which is 0.1 raised to the power n, which is 10. So if we do this, we are going to have 614.46 plus 385.54. We add all of that, that is going to give us $1,000. So that is the value of the bond. It's going to be the value or the price or the worth of this bond. So that's how we are going to value bonds. We use the formula, our understanding of all future cash flows. So the future cash flows are the periodic coupon payments and the lump sum, which is that par value that is paid at the end of the life of the bond. So the bond value accordingly will be present value of an ordinary annuity plus present value of the maturity value or the lump sum. So we use our knowledge of time value of money and we can solve this easily. We can solve this easily. Or if we're using the financial calculator, we basically would take, because we want to calculate the value of the bond, which is the present value, So with the financial calculator, we will we'll type 10 and then we'll type N, we'll press N on our calculator. We will take N, and this is bar 2 plus financial calculator. We'll take N again for interest rate. Interest rate is I/Y. And then we will take 100 and we'll type payment. And lastly, we are going to take 1,000, which is that future value, and we'll press compute present value, and the calculator is going to give us $1,000. So we can either do it manually and have 1,000, or we can use the financial calculator and that generates 1,000. So what we are seeing here is very interesting. The value of the bond is actually equivalent to the par value, because the par value was 1,000. So in this case, and this case alone, the value of the bond is equivalent to the par value. So we can state a very strong principle: if yield to maturity, which is that interest rate, is equivalent to the coupon rate. So the yield to maturity is 10, because we are told that the bond consists of, is a 10-year bond. It has a 10%, it's a 10% coupon bond, and the yield to maturity is 10%. So we have seen that the yield to maturity is equivalent to the coupon rate. If this happens, then what we are going to find is that the bond value is going to be equivalent to the par value. And that's what we are finding. It's going to be equivalent to the par value. If the yield to maturity is equivalent to the coupon rate, then the bond value is going to be equivalent to the par value. All right? So that's a very important concept that we have established. So let's look at this. This question says, what happened if expected inflation rose by 3%, causing the yield to increase to 13%? So what we are finding now is that yield is going up. Yield is going up. So our yield to maturity is 13%. Our coupon rate is 10%. Our coupon rate is 10%. So if we use the financial calculator, or we can use the formula, everything remains the same except that yield to maturity becomes 13%. So what we find is that, so let's do this with financial calculator. 10, take N, now 13 instead of 10, I/Y. Now we have 100, take it in as payment. We have 1,000, take it in as future value. Press compute, present value, and is going to generate 837.21. And we see that this amount is less than par value. It's less than par value. So when the yield to maturity rise above the coupon rate, the bond value falls below par. So the bond sells at a discount. This is another important concept. So if the yield to maturity is greater than the coupon rate, which we have seen, yield to maturity now increases to 13%, which is greater than the coupon rate of 10%. What we find is that the bond value is less than the par value. So the bond is selling at a discount. Bond value or the sales price is at a discount. All right. Let's look at the case for which the yield to maturity falls. If the yield to maturity declines to 7%, and we do the same thing, once we do the same thing, compute present value, we'll find that the bond value is 1 to 10.71, which is a premium bond. It's a premium bond. So we can conclude that if coupon rate is greater than the yield rise above par, and the bond is selling at a premium. The bond is selling at a premium. If yield is greater than the coupon rate, then the bond's value is less than the par. As a reverse. So if the yield is less than the coupon rate, so we have seen that the yield is 7%, coupon rate is 10%, then the bond's value is greater than par. So it is greater, which means that the bond is a premium bond, is selling at the premium. So we can now see a clear relationship between yield and bonds value and bonds value. So we can draw something like this, where the y-axis is the bond value and the x-axis is the yield to maturity. So interest rate or yield to maturity. And that relationship is an inverse relationship, which is something like this. So when yield is low, bond value is high. But if yield to maturity goes up, if yield to maturity is high, bond value goes down. So it's an inverse relationship. Okay. So bond value versus years remaining to maturity. So as years to maturity is coming, the bond value all gravitate towards the par. So it is going to come to the par value. It's going to come to the par value. And we can see this on this diagram. So here we have the bond value against time to against maturity. And we have here the par value. And let's look at this example where we have the bond selling at a discount. So selling at a discount means the bond is selling for less than the par. And then here we have the bond selling at a premium, which means the bond is selling for greater than the par. So even for the premium bond, as maturity is approaching, the bond value gets closer and closer to the par value. And for discount bond, as maturity is approaching, the bond's value get closer and closer to the par value, to the par value. All right? Yeah. So this establishes some of the things we just mentioned. At maturity, the value of any bond must equal to its par. The value of a premium bond would decrease to its par. The value of a discount bond is going to increase towards its par. The par bond stays at par if the yield to maturity remains constant. Okay. What's yield to maturity? Yield to maturity is the rate of return earned on the bond held at maturity, also called the promised yield. So it's that rate of return that you are going to earn if you hold a bond till maturity. It assumes the bond will not default. So we can look at a question like this and put it in perspective. So we are interested in the yield to maturity on a 10-year bond, 9% annual coupon, 1,000 par value, bond selling for 887. So if this is selling for 887, means the price at the moment is 887. The respective coupon is $90 because it is 9% of par, which is 1,000. And that is true year after year. Then we'll have the par value at the end of the life of that bond. So we are interested in understanding the yield. What is it that will bring all of this present value together to this sum? What is the interest rate? What is the interest rate? So to do this manually, where we are trying to get this yield to maturity, becomes challenging to do. So the financial calculator will get this easily for us because we have everything in place. So we are basically interested in computing I/Y. So using the financial calculator, we are going to take type 10, type N for number of years. We can take negative 887. This is the present value at the moment. That's the present value. We can type 90, which is the payment. Then 1,000, which is the future value. Compute for us interest rate or the yield, I/Y, and the calculator will give us 10.91. 10.91. All right, so some of the things we have established: if the coupon rate is less than the yield to maturity, the bond is going to sell at a discount. True. If the coupon rate is equivalent to the yield to maturity, the bond is going to sell at its par value. True. If the coupon rate is greater than the yield to maturity, the bond is going to sell at premium. If yield to maturity rises, bond price is going to fall. The inverse relationship we have seen. Bond price is equivalent to par at maturity. So whether it is premium bond or discount bond, they all move towards the par as the bond gets to maturity. Okay. All right, if this question says, if the price were this, what is the yield to maturity? So everything is the same as before, except that the present value now has changed from 1,000 to 1,134.2. So using the financial calculator 10, take it in as NPV, which is the present value. I can take negative so that my answer is going to be, so that there's no error because I'm typing in both present and future value. One of them must take negative. Something needs to come in for something to go out. So present value negative 1134.2, payment, oh no. So I'll type 10 first in, then I'll type negative 1134.2. I take that as present value. I'll type 90 and take that as payment. I'll type 1,000 and take that as future value. Then I want the calculator to compute for me I/Y, and I'm going to have 7.08. Okay. Okay, let's look at these definitions on current yield and capital gain. So these are the two types of ways that investors tend to make return: current yield and capital gain. So investors' total return, which is yield to maturity, is equivalent to expected current yield plus expected capital gain yield. And current yield is basically annual coupon payment divided by current price. So that portion of investors' profit is really based on the periodic coupon that they are receiving. And then capital gain is basically change in price, how the instrument, how bonds have changed in price. So capital gain is going to be change in price. So it might be price right now minus past price divided by past price. So change in price divided by beginning price. All right, let's look at this example. It says a 9% coupon, 10 years bond, the price is 887, and the yield to maturity is 10.91. So what is the current yield? What is the current yield? So from the formula we just discussed above, we said the current yield is equivalent to annual coupon payment divided by current price. So this is a 9% coupon, and it is assumed that the face value is 1,000. So annual coupon payment is going to be 90 because it is 9% of 1,000. And then the current price is 887, which means that the current yield is going to be 10.15%. 10.15%. Okay. So if that is the current yield, we might want to consider the capital gain. And we already know that the total yield or the yield to maturity is equivalent to the current yield plus the capital gain yield plus the capital gain yield. So which means that we can calculate the capital gain yield by taking the yield to maturity minus the current yield, So we come here, what we are saying is that the capital gain yield is the yield to maturity minus the current yield. The yield to maturity is given as 10.91. We have computed the current yield, which we have 10.15. This implies that the capital gain yield is going to be 0.76%. Okay. All right. Another concept that we want to bring into this chapter is semi-annual coupon. Very similar to the concept of time value of money, where compounding is done more frequently than annually. So what if the coupons are structured in such a way that they are being paid semi-annually instead of annually? So we can calculate different things, basically making adjustments. We need to make some adjustments. So what are some of the adjustments we need to make? We need to multiply years by 2 to get the period. So the period used to be N. If it is a semi-annual coupon, which means coupon is being paid every 6 months. It means within that 2 years, payment will be made for 4 years because it's going to be 2 times 2. So that is the adjustment we need to make. We need to multiply M by 2. Another adjustment is to divide the nominal rate by 2. So the interest rate must also be divided by 2. And then we need to divide the annual interest or coupon by 2 to get the payment. So the payment is going to be the coupon that is paid yearly, or the coupon interest that is paid yearly divided by 2. So that's the adjustments we make. Let's look at this example. We're interested in calculating the value of a 10-year bond. It has a 10% coupon, semi-annual coupon if the rate or the yield to maturity is equivalent to 13%. So here we are going to make all the adjustments that we mentioned. So number of period will be adjusted by multiplying by 2. Interest rate will be adjusted by dividing by 2. And the payment is a 10% coupon on 1,000 bond is going to be divided by 2. And we are going to have $50. So which means that if we are doing this using our financial calculator, we are going to take 20 as N. We are going to take 6.5 as I/Y. We are going to take 50 as payment. Then we are going to take in 1,000 as future value. Then we'll take compute present value because we're interested in the bond value. So compute present value. Once we do that, we are going to get 834.72. 834.72. Okay. All right, since bonds tend to have callable provision, we have the yield to call. So we have yield to maturity if investors hold the bond to maturity. But with callable provision, the company can call back the bond, affecting the yield of the investor. So the investor's yield will become yield to call and not yield to maturity. Yeah. So a 10-year, 10% semi-annual coupon. So this is semi-annual. 1,000 par value bond is selling for a premium of 1,135.9 with an 8% yield to maturity. It can be called after 5 years at 1,050. So if this can be called, then we can calculate the yield to call. It is very similar to the yield to maturity, but we are using 5 years because that is when the call provision can be exercised, even though this is a 10 years, this is a 10 years bond. So in that case, N is going to be 10. So we can do like this. We take 10 and we type N for number of years. And then we take the present value. The bond is currently selling for, so 1135.9. That is the present value. And the payment is going to be, so it is a 10% coupon. So it is 10% of 1,000, but it is a semi-annual bond. So we divide it by 2 and we take that in as payment. Then for the future value, since we're interested in yield to call, it can be called in 5 years. So that's why this is 10. So this is 5 years, but it is semi-annual. So it's semi-annual. Then we take 1050 as future value and we compute present value, which is going to give us not present value. We are interested in the yield. We already have present value. So compute for us I/Y, which is going to be 7.53. So again, N is 5 times 2, present value, 1135.9. We're taking negative because we're inputting present and future value. So there must be something into the system for something to be generated by the system. Our payment is going to be $50. Our payment is 10% of 1,000 divided by 2. And then the future value is the core amount, which is 1,050. So that gives us compute I/Y, which is 7.53, 7.53. Okay, so we can ask a question. If you buy a bond and it's a callable bond, are you likely to generate yield to maturity or yield to call? Most likely yield to call, because if interest rates start going up, the issuer is going to exercise that call provision and they'll terminate the life of the bond. So the borrower's return will be yield to call rather than yield to maturity. However, it really depends whether it's a premium or it is a discount bond. So if it is a premium bond, then you will likely earn a yield to call. But if it is a discount bond, you will likely earn a yield to maturity. And the reason for this is straightforward, because as far as premium bonds concerned, the interest rates are usually low. So remember the rule of thumb, interest rate is lower than the coupon rate, the bond price or the bond value is going to be greater than par. So if interest rate is lower, what that means is that interest rate can only go up. And if interest rate goes up, then the issuer of this bond is going to exercise their call provision. So which means that if you hold a premium bond, you most likely earn a yield to call. But for discount bond, interest rates are already high, because for discount bond, we said the yield to maturity is greater than the coupon rate. So the bond sells for less. So if we begin from a position where interest rates are high, then we expect that rates will only go down. So if rates go down, there is no need for the issuer to try to refinance their loan. Because they start from a place where rates are high and rates are going down. So they are paying if rates are going down, so they are better off. So again, one more time, if you hold a premium bond, you most likely earn a yield to call, because you start from a position where you have a lower interest rate. So interest rates are going to climb, and if interest rates are climbing, you want to not continue to pay high. Right? Let's see this concept. So for premium bond, what we said is that the yield is less than the coupon rate. So the bond value is greater than the par. So if this is less, it means that rates are low. So you start from a place where rates are low. So but these rates start climbing. So if you start climbing, then the call provision will be exercised. And the reverse is true for a discount bond. All right. So let's talk about some few things as we round up this chapter. This is the cost of debt, the pre-tax tax cost of debt, because this is the yield on debt. So this is what makes up the cost of debt. So it is RD, which is the required rate of return on a debt security. It is this real rate of return plus inflation premium compensating investors because of inflation in the market. Then there is maturity risk premium. Maturity risk premium changes in market interest rate can cause a large change in the price of long-term bond. So that factors into the required rate of return on the debt security. Then there is also the default risk premium, possibility that issuer will not pay interest or principal. So that needs to be factored out. And then there is the liquidity premium, which reflect the fact that some securities cannot be converted to cash on a short notice at a reasonable price. So these are the things that will be considered in coming out with the required rate of return on the bond. So those things I just discussed a little bit more. Spread, it's also an important concept. A bond spread is often calculated by taking the difference between the corporate bond yield. So the spread is the difference between the yield and the treasury security yield of the same maturity. So what spread actually captures? It captures the default risk premium and the liquidity risk. So if the spread is getting larger, it implies that default risk premium and liquidity risk premium is increasing. So bonds of large, strong companies tend to have a very small liquidity premium. So they can easily be converted because these companies are large and they are well known. Bonds of smaller companies tend to have liquidity premium that is high. Since we are talking about bonds, there are rating agencies. In fact, there are 3 rating agencies that rate bonds. We have S&P, we have Fitch, and we have Moody. And they can rate bonds based on different grades. Quality grade bonds will be investment grade bonds, and then low quality will be junk bonds. Or speculative bonds. But what we see that as far as default is concerned, bonds that have high rating, they tend to have low default. Bonds that have low rating, they tend to have very high default rate. In terms of yield, bonds that have high rating, they tend to have low yield. Bonds that have low rating, they tend to have high yield. This makes sense. Investors will demand more for taking more risks if they're investing in junk bonds. As far as the spread is concerned, we already said spread kind of capture the default risk and liquidity risk. So bonds of high rating, they tend to have lower spread, whereas bonds of low rating, they tend to have higher spread. Okay, there are some things that tend to affect default risk and bond rating that include things like financial ratios of the companies is going to affect their bond ratings and even their default risks. we can see that bonds that have high rating tend to have high return on capital, whereas bonds with low rating tend to have low return on capital. And the same is true with debt ratio. Bonds with high rating, lower debt ratio, excuse me, whereas bonds with low rating, they are more indebted. So they tend to have a high debt ratio. So the other things that will tend to affect bond rating and default risk, we include other factors. So we include things like the provisions that are in the bond contract. So provisions that are in the bond contract, whether it's a secure or an unsecured debt. So if it is a secure debt, the company generally pledge a particular asset that may be claimed by a secured debt holder in the event of default. So we expect that secured debt will tend to have higher rating than unsecured debt. And then we have senior versus subordinated debt. So in the event of bankruptcy, subordinated debt has claims on asset only after senior debt have been paid off. So in case of bankruptcy, senior debt holders needs to be paid off first before those who hold subordinated debt. So these are different provisions in the bond contract: guarantee provision, sinking fund provision, debt maturity provision. All of that will affect the bond rating, and there are other factors as well, which include things like earning stability, regulatory environment, potential product liability, and accounting policy. All right, let's look at this before we end it up. Interest rate risk for 1 year and 10 years, 10% coupon bond. So maturity risk premium. All bonds are exposed to two types of additional source of risk: interest rate risk and reinvestment risk. So that will mean that bonds that have a low maturity, they are going to sell for less compared to bonds that have a longer maturity. Because with longer maturity, we expect that there are more risks that are embedded with the length of time: interest rate risk, reinvestment risk. But there are other dynamics. There are other dynamics that are involved. So we are going to call it off at this point in time.